I would imagine you would feel some level of guilt when some of the companies that you are promoting end up leaving retail investors holding the bag.
Today, folks, Kevin Pump and Dump Leary has got caught in the cross sights of Hasan Minhaj on The Daily Show. This interview led into some of the most intriguing insights and kind of counterintuitive questions that every investor has to ask themselves about buying individual stocks and the risk that comes with that over buying ETFs. And ETFs are something that I've only taken into consideration in the last year, coming from somebody that's pretty much just bought and made his career on buying individual stocks. And I want to talk about this internal conflict and some of these questions, but you got to take a listen to a few of these clips. We'll break them down and then we'll talk more about this broader conversation.
You're speaking to the upper 1% that can lose that money. Everybody else that's listening should probably just put their money in ETF, set it aside, go to sleep, wake up 30 years later.
And that's why you need diversity. You need a lot of stocks. ETF's a good idea. It has a lot of stocks, whatever. At the end of the day,
but it's not a whatever. That position, putting your money in an SPY, S&P 500 for 30 years, is going to benefit 95% of the population.
Now, Hasan's end-all be-all. Like, he'll die on this cliff of investing of just 95% of people should just be buying ETFs and index funds. There's nothing wrong with that. I think the vast majority of people should. I'm going to offer some opinions on it, but this is where things get insane because Hasan just thinks Kevin is literally pumping stocks onto retail investors and leaving them with the bag. And just listen to what he says about Google stock.
I understand indexing. That's great. I do that too. But if you want extraordinary returns, you got to take risks on entrepreneurs. You have to back people that don't know their outcome. If you had a chance to invest in Google when its valuation was $5 million, do you wish you did that?
Sure. Yes. But hindsight is 20/20 always, and you will lose that way.
Why would you lose that way?
You can lose 95% of the time.
I gotta side with Kevin O'Leary to some varying degrees here because Hasan just kind of is going to continue to talk about how he's pump and dumping these stocks on retail investors. He's not properly clarifying the information. I'm going to admit that 95% of investors are going to lose money buying individual stocks because they listen to the media. That's where they get their information from, and that's what every retail investor under the sun is hearing at the same time. So crypto gets pumped. Everyone buys it when it's pumping. They tend to lose it. They hold it long term. Tesla, a lot of these small cap companies, a lot of these people get in when everyone and their grandmother wants to get into it, not beforehand. But if you have a statistical edge, if you've done research and you believe you know something no one does because you have an edge in an industry, something Warren Buffett, Charlie Munger talk about, you might be better off taking a small percentage of your portfolio and making intelligent investments. And I'm going to give you an example of a highly risky investment. The first stock I ever bought back in like 2014-15 timeframe, I was buying Canopy Growth Corp for $3 a share roughly. And this was a bet that I figured out when I was in my early 20s. I was like 23 years old. And this was such a simple bet. I said, look, they're going to legalize the MJ market here in Canada in 2018. It's been announced. They're going to do it. There's no backpedaling. It was so proven. And I was like, why is no one buying these companies? So I loaded up on Canopy Growth Corp. And sure enough, as soon as legalization talks started to become more heated between 2017 and 2018, the stock exploded. I was selling out in the 20s and 30s, made tens of thousands of dollars, a small fortune. It was like my first unicorn ever. I thought I'd only get one of these in my lifetime. My mother held on a little longer. She sold out in the 50s. She did very well on this one. It was kind of funny how we were both paying attention to this over a few years. And again, this wasn't money made overnight, guys. We did the research prior, cost averaged into it, and then just held it until this legalization phase. This was like a 2 or 3 year old ordeal. Same thing with MindMed. This was a stock that we got into along with Kevin O'Leary, which he doesn't talk about this at all anymore, because I still think psychedelics are going to change the world and perhaps be one of the most profound changes in medicine. And we were buying this thing for like 50 to 70 cents a share. They did a pre-split, so these numbers aren't accurate, but this thing exploded. It was one of the biggest gains I've ever made in the market. People in our chat groups made like $500,000 off this trade. And then of course you take your profits, you diligently diversify your portfolio so you don't get this crazy downside risk after the fact. A lot of people miss out on crazy gains because they think these things continue to go to the moon, like the Dogecoin millionaire. Tesla, the third unicorn that I caught in 2019 when it was super controversial. When I first bought this, it dropped like 15%. And then sure enough, holding on to it for a couple of years, this thing rallied to the moon. We made a small fortune. We got out. Doesn't always go that way, but you mitigate your risk, right? Because I've picked horrible stocks like GEO Group. I got into this one, lost 50% of my money. But because I only put such a small percentage of my net worth in it, these stocks that went up like 500, 1,000%, well outsized any of the losses I experienced in these horrible stocks like Momentous. This company had a partnership with Tesla. They were going to be a space utility company fixing satellites in space. But then sure enough, the CEO, being some Russian guy living in the US that didn't have a US citizenship, caused this crazy drama drama and the stock tanked and it's never recovered, right? But on the same notion, I'm still trying to achieve these same kind of intellectual picks, things that I think I could have an edge on through educating myself and understanding balance sheets. In very simple terms, look at TSM. This is not financial advice by any metric. A stock that's trading for, 14 PE, whereas Apple, Microsoft, these companies are in the 20s and 30s times multiples. Yet look at this thing. Not only is this company hiring employees where everyone else is laying employees off, their cash flow went from something like, this is in Taiwanese dollars, but I think, what was this, like $6 billion in 2019 to today, where they're generating like $17 billion in free cash flow in the US dollar conversion. And year to date on January, they posted that their revenues grew by 16% year over year in a recessionary environment. My God, right? But take a listen, because this gets way more heated.
Now, this is where I disagree with you. Here's why. You know with certainty in venture investing in startups, since the beginning of time, 8 out of 10 are going to fail. I know that, you know that, and the whole world knows that.
The system of you going on these shows, Squawk Box is financial FOMO. The graphs, the ticker, but you're on. Guys are swinging kettlebells in Greenwich. Do I got to get in now or later? Even the great Warren Buffett and Charlie Munger, the goats, these geriatric coffin dodgers, now at their shareholders meeting go, listen to me, if I could do it all over again, I would just put it in an index fund.
Now this is funny, because this is where Hasan gets it right and wrong. I think if you listen to Squawk Box, you listen to CNBC, you are going to get that FOMO and that bipolar disorder that's almost like gambling. And that's something that Warren Buffett quoted in the recent shareholder letter release, saying that most people right now are gambling. They're not in this for long-term investing. And that's because every opinion is hitting them from 9 different angles, and they can't take a breath and just do the intelligent long-term investment, cost average, diversify into a multitude of sectors, a multitude of different picks, ETFs. I don't even think buying one ETF like SPY or VT-SAX or a lot of the companies that most investors will recommend is actually an end-all be-all solution, because a lot of people don't live in the US. Some people are in Canada. Some people are in Europe, and getting that foreign exposure for them is a little bit more prudent from tax advantage reasons and for their own retirement, dealing with foreign income. I mean, there's a lot of things that you have to take into consideration from time horizons, et cetera, et cetera. But yeah, Kevin O'Leary, I think, got caught in this whirlwind, this idea of just pumping these incredibly speculative investments. It was all he was getting paid to talk about, and I think it's finally whirling around to bite him in the ass. And I think that's very important, because now it's kind of this wake-up call for regular retail investors to be educated to better understand what they're doing. Because, I mean, you go watch CoffeeZilla and you can see endless people losing their life investments listening to crypto pumping numbers. It was really, really bad. But where he also gets it wrong, Hasan Minhaj, is when he says that Warren Buffett says, oh, if I could have gone back, I would have just bought ETF. That's not what he said. He said the vast majority of people should just buy, S&P 500 ETFs. But himself, and even Charlie Munger Charlie Munger really quotes this, saying, "Oh, you might be better off buying Berkshire. I still think we're going to outperform the S&P." These guys, in their entire lives, and even to this date in Berkshire, they do have a small investment in the S&P, but that's not what they're going to go to do, because they think they know more than the average investor, and they're going to continue to lean into that for as long as it's going to work for them, and it has since their inception of investing. So, like I said, I think they're both kind of offering counter opinions here, and they're both right for the right person. That's the problem, right? Because we're all so significantly different. If you got your own perspective in life, you need to learn that, investing isn't a one size fits all shoe, and you got to figure out what's going to work for your circumstance. And like I said, for me, I don't have a guaranteed job. My job is volatile. I've been in and out of industries in the last few years thanks to the pandemic. So I'm going to focus partially on growth, partially on income. I might need that income if I lose my job. Some people have stable jobs. Some people have really good foundational jobs with unemployment benefits and all this stuff, pensions, things that I'm not going to get as nearly as much as you might. So you could just focus on broad-based ETFs. You don't have to care about dividends. You could relax, sit back for 20 or 30 years. Maybe you're trying to fast track your retirement. Maybe you need a statistical edge and you're researching like a crazy person. So maybe that might be the better thing for you. I don't know. I can only do what I do, and I document it here in hopes that you're learning something.